Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamwin here. This is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into the insights shared by Rishi Sondhi, a TD economist, who recently discussed his outlook for Canada's fragmented housing market. There's quite a bit to unpack here, so let's get into it.
That's right, Sandy. Rishi Sondhi highlighted that the Canadian housing market is experiencing significant regional disparities. While some areas are showing strength, others are weaker, particularly in Ontario and British Columbia. What stands out to you in these regional differences, Sandy?
Well, Steve, it's fascinating how Sondhi pointed out that while the overall Canadian housing market remains soft, with home sales and prices below pre-pandemic levels, there are pockets of tight market conditions. For instance, Quebec is showing robust price growth, and even Manitoba and Saskatchewan are tight markets. It really speaks to how diverse the housing landscape is across the country.
Exactly, Sandy. And Sondhi went on to say that Ontario and British Columbia are the biggest sources of weakness, dragging down the headline numbers. He expects average home prices to decline in these provinces this year, which is quite a shift from the typical narrative of these being the hottest markets.
Right, Steve. But he also mentioned that there are offsets in places like Ottawa and London where prices have been rising. This could indicate a potential inflection point in 2026, where underperforming markets might strengthen while leading markets cool down. It's a dynamic scenario.
Yes, and speaking of dynamics, Sondhi also touched on the condo market in the Greater Toronto Area. He noted that condo prices have been falling since mid-2023, and we're seeing prices return to pre-pandemic levels. This could be a double-edged sword, because while affordability improves, there's a lot of unsold inventory that needs to be addressed.
That's a great point, Steve. Falling prices can indeed improve affordability, but as Sondhi mentioned, no one wants to catch a falling knife. Yet, this could present buying opportunities in the future once buyer psychology shifts. It's all about timing and market perception.
And let's not forget, Sandy, the broader economic context. Sondhi suggested that while lower interest rates would help, the Bank of Canada is unlikely to cut rates significantly in the near future. So, any recovery in the condo market might be driven more by pent-up demand rather than rate cuts.
Absolutely, Steve. The demand is still there, even if sales levels on a per capita basis are low. It's going to be interesting to see how these factors play out, especially with Sondhi's forecast of a modest improvement in market activity going forward. It's not a dramatic rebound, but it is a step in the right direction.
Yes, Sandy, and Sondhi also touched on the broader housing supply issue. There's a lot of talk about housing shortages, especially for ground-oriented housing like semi-detached and detached homes. It's something that needs addressing if we're to meet the demand effectively.
It's true, Steve. The Prime Minister's goal of boosting housing completions to 500,000 units per year is ambitious, but Sondhi points out that according to their modeling, something closer to 400,000 would suffice to return affordability to pre-pandemic levels. It's a significant challenge, though, given Canada's historical construction rates.
So, Sandy, it looks like the Toronto condo market is shifting in favor of first-time buyers, according to a recent article by Liesl Once. With slower sales and rising listings, the market dynamics seem to be tilting towards buyers. What do you think?
Well, Steve, it's definitely an interesting development. Toronto's condo market has long been dominated by investors and rapid price gains, but now it appears to be entering a phase that offers more opportunities for first-time home buyers. With listings up and investor demand cooling, condos are increasingly seen as practical starter homes rather than speculative assets.
Victor Tran, a mortgage and real estate expert at Rates.ca, mentioned that lower purchase prices mean smaller down payments and more flexibility in structuring mortgages. For young buyers who can qualify, this combination makes condo ownership more attainable than it has been in years. It's a significant shift from the high barriers to entry we've seen before.
Absolutely, Steve. Tran pointed out that the average Toronto condo price is now around $655,000. A buyer with a 15% down payment would be looking at monthly payments comparable to renting a two-bedroom condo apartment in the Greater Toronto Area. This could be a game changer for many young people looking to enter the housing market.
There's also a broader economic context to consider. The Canadian Real Estate Association has revised its 2025 forecast, expecting national home sales to fall 1.1% and average prices to dip 1.4%. This environment might give buyers more leverage, allowing them to negotiate purchase prices below current averages.
That's true, Steve. It's one of those rare times when the numbers actually make sense for buyers who plan to stay put for at least the next 5 years. That time frame gives them a chance to manage costs, build equity, and benefit from stable housing payments. But, as Victor Tran cautioned, buyers should be selective about the type of property they pursue.
Yes, Tran advised that resale condos might be a safer choice right now, as many new developments face cost pressures, financing hurdles, and construction delays. These factors add uncertainty for buyers, so opting for a resale condo could provide more stability.
And it's not just Toronto. Similar shifts are happening in Vancouver and Calgary, where rising inventory and muted investor activity are opening doors for first-time buyers. According to Kingsley Ma from Remax Canada, it's probably one of the best times in recent years for younger buyers to get into the market, especially with interest rates potentially coming down soon.
Indeed, Sandy. While the market remains unpredictable, this period could be an opportune moment for those ready to commit to home ownership. It's about finding the right property and making a calculated decision based on the current conditions. Sandy, let's pivot to the latest news from EQB Incorporated, the parent company of Equitable Bank. They're making headlines with their announcement of an 8% workforce reduction as part of a broader restructuring plan. This is a substantial move, affecting nearly 160 positions based on their third quarter headcount of close to 2,000 full-time equivalent employees.
That's a significant shakeup, Steve. EQB's President and Chief Executive Officer, Chadwick Westlake, stated that the restructuring is aimed at sharpening their competitive edge in the Canadian financial sector. It's about concentrating capital and talent where they see leading opportunities for growth and competitive advantage. But it's never easy to see job cuts, especially when they involve a significant portion of the workforce.
True, Sandy. Westlake mentioned that these decisions, while difficult, are intended to improve productivity and drive positive operating leverage. The goal is to capture profitable opportunities and generate a strong return on equity. It seems EQB is really focusing on streamlining operations to remain competitive in a challenging market environment.
Yes, and part of this restructuring involves a pre-tax charge of around $85 million. This includes approximately $20 million in severance and related costs, and impairment charges of $65 million. Within those impairments, $28 million is tied to intangible assets as they prioritize high-return initiatives, and $24 million relates to their equipment financing business, which has been struggling with market headwinds.
It's interesting to note that EQB expects the workforce reduction to be substantially complete by the end of the fourth quarter of 2025. They'll provide further details alongside their fiscal 2025 results on December 3rd. It's a clear indication of their commitment to making swift changes to adapt to the current market conditions.
And despite the tough decisions, EQB's leadership emphasized their commitment to supporting the departing employees. Westlake thanked those who are leaving for their contributions, acknowledging their role in shaping the institution. It's important to recognize the human element in these corporate decisions.
Absolutely, Sandy. The restructuring's impact on Equitable Bank's Common Equity Tier 1 ratio is expected to be around 10 basis points. This effort comes amid heightened competition and margin pressure in the Canadian mortgage and banking sector. EQB's move is part of a broader trend, with other banks like Scotiabank also making similar workforce adjustments to strengthen profitability.
EQB operates Equitable Bank, Canada's seventh largest by assets, and ACM Advisors, focusing on alternative assets. As of July 31st, 2025, they reported $137 billion in combined assets under management and administration. It's a sizable operation, and these changes are likely aimed at ensuring they continue to perform strongly in a competitive landscape.
It's a strategic move, Sandy. By focusing on areas with the potential for growth, EQB is trying to position itself to better weather the challenges of the financial sector. It'll be interesting to see how these changes impact their performance in the coming quarters.
Let's shift our focus to a significant regulatory development in the mortgage industry. The Financial Services Regulatory Authority of Ontario, or FSRA, has recently taken decisive action against several mortgage brokers and agents for various regulatory breaches. This is a big move, with FSRA imposing $430,000 in administrative penalties and revoking a brokerage license. Steve, what are your thoughts on this crackdown?
It's a substantial development, Sandy. FSRA's actions seem to be part of a broader effort to ensure compliance and protect consumers, especially those who are vulnerable. The penalties and revoked licenses are a clear message that the regulator is serious about maintaining the integrity of the mortgage industry.
Absolutely, Steve. FSRA's investigation revealed some troubling practices, including unsuitable and high-fee mortgages that left many clients, particularly those on fixed incomes, in significant financial distress. It's a reminder of the importance of ethical practices in the industry.
Yes, Sandy. The enforcement actions involved multiple parties, including Kim Thon Do, who was fined $140,000 for dealing in mortgages outside her authorizing brokerage and facilitating unlicensed activities. It's crucial for brokers to operate within the legal frameworks to prevent such harm to clients.
Indeed, Steve. The penalties also extended to unlicensed individuals and entities like Gula George Zambach and 5,015,977 Ontario Inc., highlighting FSRA's commitment to cracking down on unlicensed activities. It's about ensuring that everyone in the industry follows the rules to protect consumers.
The fines imposed on Myriad Mortgage and its principal broker, Bruce Rene Cotis, further underscore the importance of compliance. They were penalized for failing to ensure mortgage suitability and maintain accurate records, which are critical responsibilities in this industry.
That's right, Steve. FSRA's actions are not just about penalties, but also about setting a precedent. They emphasize the need for principal brokers to oversee their agents diligently and maintain proper records. It's about accountability and consumer protection.
And it's worth noting, Sandy, that FSRA's recent actions align with a broader trend of increased scrutiny on mortgage suitability and disclosure practices, especially concerning seniors and at-risk borrowers. This is a necessary step towards enhancing consumer trust in the mortgage industry.
FSRA's focus on protecting vulnerable consumers is commendable, Steve. It's crucial to ensure that mortgage products are suitable for the clients they serve. The recent settlements and ongoing enforcement actions reflect FSRA's commitment to these principles.
Exactly, Sandy. This regulatory crackdown serves as a wake-up call for the industry to prioritize compliance and consumer protection. It's a reminder that the actions of a few can have wide-reaching implications and that maintaining ethical standards is non-negotiable.
Well, Steve, that wraps up our discussion for today. It's been an insightful episode, covering everything from market trends to regulatory updates. Remember, staying informed is key to navigating the ever-evolving world of mortgages and real estate.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.